Hi, everyone. So, welcome to the stream today as we continue with our discussion for the November 2025 examination. And we've been on the journey looking at the series in respect of the various things that we need to understand when it comes to financial reporting and corporate reporting, solving questions and trying to crystallize the principles in respect of these areas. And that is exactly what we want to continue with and do today, and take a look at another question that will be crucial for us as we go into the exam hall. Remember that you can get access to our practice question course available on our website, NhyiraPremium.com. You can get access to the full course. This gives you access to practice questions covering the entire syllabus in corporate reporting and financial reporting, so you can prepare well to go into the exam hall, write the exam with confidence, and most importantly, pass the examination. So you can send us a message on WhatsApp or visit our website to check the course and also conclude and make an enrollment for it. It is going to give you access to a lot of practice questions video, question kits, going to have a mentorship session with me, and also that will give you the tickets to be able to join our Executive Leadership Masterclass, which is our executive masterclass for the examination, and that is going to really help you so you can go into the exam hall and pass the exam. So you want a full access to all these and more, you can get access to our complete course. Send us a message on WhatsApp or go to the website, Nhyira Premium, or you can download the Nhyira Premium mobile application on the Google Play Store or the App Store, and you'll be able to complete your enrollment and get access to all of those contents. So today we want to get excited into the discussion and look at one other area that will be crucial for us in the exam hall, and that is the single entity financial statement. This is going to be crucial for both financial reporting and corporate reporting students. We want to look at the concept in respect of IAS 7, which is the preparation of the cash flow statement. Remember that the cash flow statement is a single entity financial statement that the examiner will be asking in financial reporting that you are going to be required to do if the examiner wants to. However, in corporate reporting, either you will be asked to prepare the consolidated cash flow statement, which is question 1, or you are going to be asked to interpret the cash flow statement for an entity, which is the cash flow analysis. So for corporate reporting students, cash flow preparation, it's very crucial because it could be in question 1 where you are preparing the consolidated cash flow, or question 5 where you are analyzing the cash flow statement. And so understanding the way the cash flow statement is prepared, and most importantly, how the whole concept comes together in respect of its analysis, will help you as you go into the exam hall. So let's get excited and let's look into the discussion. We want to look at the ICAG question July 2025 financial reporting paper, and we're going to be answering question number 3, which is the single entity financial statement cash flow statement. But before then, I want to share some few things with you about some notable weaknesses that the chief examiner shared with us from just the July 2025 examination. It is important you understand the things that people have done in the past so that helps you to plan for your future well as you go into the exam hall. So what are some notable weaknesses that the examiner identified? So number 1, despite good scores in question 1, many candidates struggled with a correct presentation of the consolidated financial statement. Now, that is question 1, consolidated financial statement. So, per the chief examiner, students struggle with the presentation. Then number 2, a considerable number of candidates lacked understanding of IFRS 15, affecting their performance in question 2A. So the accounting standards, understanding the principles in the accounting standards, and most importantly, applying the principles in accounting standards continue to be something that students are not really working at. So you have to be mindful of that. 3, question 3 on preparation of the cash flow statement posed the greatest challenge to most candidates. Some candidates did not appear to know the format and content of the statement of cash flow, and they failed to present their answers accordingly. You cannot go to the exam hall without having no clue in respect or without having information about how you prepare cash flow statement. And that is what I keep on telling you, that you must thoroughly go through the syllabus. You must thoroughly understand everything in the syllabus. That is why last minute showdown cannot work. That is why 3 days to the exam, the leave you take from your workplace, thinking you can crumble everything, it cannot work. You must go through the syllabus and understand everything. Again, that is why joining our community, enrolling in our course or our practice question course helps you to go through the entire syllabus so that you have an idea and have a deeper understanding of the principles, crystallizing the principles, how the examiner is going to be setting the questions, and most importantly, how you are expected to present and answer the questions. And these are going to be crucial if you are going to pass the examination. Question 4. Which was previously considered an easy session, proved challenging this examination. Why? Because the examiner brought a question on common size analysis. And students were familiar with, hey, let's use the formula, profitability ratios, liquidity ratios, and all of those things. But that same ratio calculation can be presented in the vertical financial statement or the common size financial statement. And so students had problem with that. And then suddenly the examiner said, many candidates failed to apply the relevant IFRSs correctly, highlighting the need for a stronger grasp of the standards. Listen, you cannot go into any financial reporting examination or corporate reporting examination without having a solid understanding of the accounting standards. Again, that is why if you enroll in our course, financial reporting or corporate reporting, we have the summary videos covering all the accounting standards and the key principles that you have to understand. And so that way you can go through the syllabus in record time, understanding the principles, understanding the concept. Now, after that, then you can get access to our practice question course as well, because the practice question course now also breaks down and crystallizes the principles using questions from various angles, various perspectives to help you so you understand the syllabus very well and put yourself in the position to go into the exam hall, write the exam with confidence, and most importantly, pass the examination. So these were some of the things that the chief examiner made or raised concern on that we need to be mindful of. So for the future, what does the chief examiner say? The exam results indicate that some candidates demonstrated strong knowledge in group accounting. Future candidates should prioritize not only calculation, but also structured presentations. That's very important, because if you follow my work, one of the things you hear me say all the time is professional presentation. Professional presentation, professional presentation. That's very important. And then the final thing is regular practice with full financial statement presentation, IFRS case studies, and exam simulation exercises will enhance performance in future settings. Again, our community, our platform has these in place. So you have the summary videos, you have the practice questions, videos that you can watch, then you have the live practice question content also available that you can go through the simulation live. That way you are working with your speed, your accuracy, and your ability to recollect information in record time so you can really be prepared for the examination. So these are some of the things that the chief examiner raised concern on, and recommendations that the chief examiner makes that you must be mindful of. So now let's come to our main area for the discussion. We are looking at question 3, July 2025. ICAG examination. Question 3, July 2025 ICAG examination. And it is a cash flow statement, single entity financial statement. Very easy. I mean, one of the easiest areas that you can get in the exam hall if you really understand, cash flow statements. So let's look at what we have here. For 17 marks, the examiner says prepare a statement of cash flows for Blamu PLC for the year ended 31st October 2024 in accordance with IAS 7 statement of cash flows. And that is for 17 marks. All right. So let's get goosebumps and bring our things up. What's the name of our company? Blamu PLC. So we are preparing a statement of cash flow. For the year ended 31st October 24? Yep. Then we're going to tell the examiner we like to work 2 cash columns. I don't know whether we are working 3 zeros up. Are we? Yep, we do. As always, when it comes to the cash flow statement, we're going to be starting with a cash flow from operating activities. So cash flow from operating activities. Then you're going to be starting with profit before tax figure for the year. Then you make various adjustments. That's the pro forma, right? So knowing the pro forma on how we prepare the cash flow statement is very important. Then the various adjustments are going to follow. Okay, so that is my financial statement. Let's come to the question. The financial statement of Blamu PLC, a retailer of electronic products, are given below. Okay, so we see a number of things, PPE there. You see cash in hand and cash at bank there. We see equity. You can see that equity is going up in value, meaning the company might have issued some shares. You can see share deals, which is the same as share premium, also going up in value. We'll come back to retained earnings later. You see 7% loan note here, also going up in value. It could mean that the entity, now you have to be careful about the year. Here we have 2023 and 2024. So we are moving from the right to the left. You have to be careful because sometimes it could be the left to the right. Remember, if you miss the dating issue, it means everything you've done is au revoir, mon ami, because you're not going to get any marks for it. So 7% loan note is going up. Probably the entity has issued some loan notes. We'll come back to that. Obligation under finance lease, okay, means leases will be calculated for. We see deferred taxation, okay, that means because we have to calculate the tax paid by the entity, so that will be reflected in the tax account. Trade payable, will bring it up. We see overdraft, okay. So bank overdraft, we'll come back to that later. Warranties are going up. That must be adjusted for provisions in the P&L account. So we'll come back to that. Then we see the leases as well coming back up. Then we are given the statement of profit or loss. Remember, we use the income statement or the statement of profit or loss of the current year. And then for the statement of financial position, we need the current year and the previous year. So very important. And so if you look at this current year, we are interested in this particular figure first. That is a profit before tax. So we can set it out. I have my profit before tax there. That is 7794. 7794. Then we're going to follow through with various adjustments that has to be made. And so the finance cost must be added back because it was deducted in arriving at this figure. And the finance cost paid must come at the bottom of the cash flow from operating activities. So we're going to be adding it back from above. And that is 4858. No, 4854, I think so. Yep. And so in the income statement, that is what we can do there. Let's continue. We've been given statement of changes in equity as well. That's a good news for us because we can see that the entity paid dividend of 3,000 during the year. Remember, dividend paid during the year can either be under the operating activities or in the financing activities. So when it comes to the presentation of the cash flows, dividend paid can be under operating or under financing. Whichever place you bring it, you are correct. Then we are seeing issue of shares. Issue of shares. In total, the entity issued shares valued at 900 because you see that the share deals, which is like a share premium, has gone up. You see the share capital also goes up. Now, you know that when we issue shares above their nominal value, the profit on the share issue is taken to the share deals account, or if you want, the share premium account. So if the nominal value of the share is, say, 10 cedis, but we issue the shares at 12.5 Ghana cedis, then the 10 cedi by the number of shares issues will go to the share capital. Then the 2.5 by the number of shares we issued will go to the share deals account. So from this illustration here, it tells us that this is a cash proceeds, okay, a cash issue, if you want, here. The reason why that clarity is important is because sometimes there will be increase in the share capital, but it will be as a result of bonus issue, or it will be as a result of share exchange to finance the acquisition. So it is not all the time that when your share capital is going up, you will clap your hands and say, oh, what a merciful God. And the entity has issued shares. Let me bring it under financing activities. Sometimes you can see that there is issue of shares, but may not be a cash issue. It may be a bonus issue, or if you want, a share exchange deal, especially for corporate reporting students. And we'll come back to that as we continue in the discussion. So let's come to the additional information given to us, because that's going to also open us up for a lot of things. Note 1. An item of plant with a carrying amount of this. Remember, you are working 3 zeros up. So whatever we read in the footnote, we're going to cancel 3 zeros out. Okay? An item of plant with a carrying amount of 5,790,000 was sold at a loss of 300,000 cedis during the year. Please stay with me carefully. So the entity sold this plant and made a loss. Now, loss on disposal, how is it treated in the P&L? It is subtracted in the P&L. So it means that has been deducted in arriving at the profit before tax 7794. So what do? We add it back to the profit. So loss from disposal of plant. How much we got? 300. Now we need the proceeds from the disposal, because the proceeds from the disposal must go to investing activities. You know that, right? So I'm going to build that into my system. If you want to go this way, you want to make sure you are living in reasonable space. So cash flow from investing activities. So let's get a proceeds from the Sale of plant. Now, how do you get the proceeds here? The carrying amount was 5790. And we made a loss of 300. What does that mean? It means the proceed was below the carrying amount. So to get a proceed, we'll subtract the loss from the carrying amount. So 5790 minus the loss of 300, and that will give us the proceeds we had. Principles. The carrying amount is 5790. We made a loss of 300. It tells you that the proceeds was less than the carrying amount. That's why we made a loss. So if I want the proceeds, I subtract the loss from the carrying amount, and that will give me my proceeds. So 5790 minus 300, and that is 5490. And that will be in the first cash column, 5490. So that is the treatment for that. Again, you pay attention. I'm reading, hold my breath, interpret, work. Reading, hold my breath, interpret, work. As I say always, you don't have to read everything because you will be processing a lot of information at the same time. Let's continue. Depreciation of 14,370 was charged to operating expenses for property, plant, and equipment in the year ended 31st October 2024. Now, you know what we do with depreciation already. It's going to be added back because it's a non-cash item when we are in the cash flow. So depreciation, 14,370. So we add it back to our workflow. But remember, that depreciation will be feeding into our property, plant, and equipment workings. So we come to our working slide, and we go to property, plant, and equipment. So I'm going with tier account, right? So the depreciation will come on the credit side of this account. How much is it? 14,370. Then the asset we dispose of. The carrying amount of the plant you disposed of will also go there. 5790. Okay? It will also go on the credit side. Then if you want, we can go to the statement of financial position. Last year's figure will be the opening balance. On the debit side, this is PPE. So balance brought forward. And that is 83,508. 83,508. Then you're going to pretend to close the account so that the current year figure will be the carry down, which is 96,624. 96,624. So that is the workflow, because we need to balance this account to see, because there is disposal, there is depreciation already. Maybe there was an additional acquisition they did during the year, and that will come under investing activities. So we'll come back to this workflow. So from my workings, or from the footnote 1, this is what I can do. Again, before you can get to this realm where you read a footnote and then you know everything else you are supposed to do, it means you really understand the topic, right? And then you really understand the standards, so that when you read, you know whatever adjustments that are required to be made at the end of the day. And that is, again, very important. Very important. So that is footnote 1 and the various things we can do with it. So we got our loss on disposal adjusted for in the operating activities. We got our proceeds from the disposal coming in the investing or under investing activities. Depreciation for the year adjusted for in the operating activities. And then the depreciation for the year and the carried amount of the asset disposed also coming in, being adjusted for in workings 1, the property, plant, and equipment. So let's continue to read and see what else we have. Note 2. New assets were acquired under finance leases in the year. Oh, okay. The fair value of these assets at acquisition was 5760. Okay. So, what do? They acquire new assets under lease. So, we have PPE here already. So, we will say leased asset. So, we bring that up. How much we got? 5760. But remember the double entry. You're going to debit PPE and credit leases. So I go to workings 2 to bring in the finance lease obligation as per IFRS 16. So the double entry for this is to debit property, plant, and equipment, and then you are crediting the finance lease obligation here. So I could say PPE during the year. That is the 5760. That's how you complete the double entry principle. But then, since the lease story has come up, remember we had the lease. So let's bring the lease up. Both the current and non-current will be coming in the account so that we can get a finance lease that has been paid during the year that will go into the financing activities later. So let's go bring the opening balance. This is a liability, so balance brought forward. We're going to have the current issue. We're going to have the non-current issue. So let's go. The current lease obligation, let me clean this, make some room so you can see. Current lease obligation, last year is 270. We will pretend to close this as always. And we're going to have balance carried down. Here, current, non-current. The closing balance for the current is 900. Then we look at the non-current as well. What do we have? The non-current, let me highlight that as well. 2136. Opening, and then the closing figure will be 5958. There we go. So that is the idea there. Now you want to go into the P&L account, whether they charged anything in the P&L. Okay, there's nothing in the P&L that is giving us any indication about whether there has been any lease charge to the P&L. Because if there is any lease charge to the P&L, then the double entry is to debit P&L, then we'll credit the lease obligation. That's very important, but in this case, we don't have that. So that is what we can do with the footnote 2. New asset has been leased, debit PPE, credit lease obligation, then you open the lease obligation account so that you bring in the opening and the closing balances, because you're going to balance this up, and the difference will be the capital lease payment for the year, which will go under the investing activities in our cash flow. All right. So note 2. Let's go to note 3. There were no acquisition or disposals of intangible assets during the year. Wait. there were no acquisition or disposal of intangible assets during the year. So we go back, you remember we saw intangible assets earlier under the non-current assets. So if per the note, there were no acquisition and disposal, but we are seeing the intangible asset reducing in value, what is that? Amortization. Because the intangible assets are going to be amortized over the economic useful life if the intangible assets are assets with a definite economic useful life as per IAS 38. But where the intangible assets have no definite economic useful life, then we will test for impairment. And so the reduction in this intangible asset, since the entity did not dispose of anything, could mean amortization or impairment, which then means that had been written off in the P&L account. So what we're going to do, we add it back to the profit for the year under the operating activities. So it could be called amortization. It could also be called impairment of the intangible assets because each of them can be the reason for the reduction. Hey, I'm writing importation. Oh, Nhyira. Impairment of intangible assets. So what do we have? Let's see what we got. Last year, 10,590. Currently, the figure is 8634. Right? So impairment or amortization of intangible assets was subtracted, so we are adding back. So 10,590 minus 8634. Is it 8634? Yep. And that is 1956. We're going to add it. Okay. So that is the treatment of the intangible asset. And the reason we adopted that treatment is because of the footnote 3. No addition, no disposal. So the reduction in the intangible asset will be either an amortization or impairment loss. Principles. Okay. Note 4. The company issued new shares at full market value. Okay. So this is going back to confirm what we mentioned earlier, that the issue of share here is a cash issue. So the 900 is a cash issue that will come under the financing activities. Because remember, as I said, there could be issue of shares, but maybe a bonus issue. Bonus issue doesn't give us any money. It is just an additional share that is issued to the shareholders by converting the reserves into share capital. Or it could be a share exchange under consolidation. As part of the fair value of consideration transferred, the entity can issue shares. So that is why I mentioned earlier, you can see issue of shares, but it may be a bonus issue. It may be a share exchange arrangement. In our case here, it is what the default rule is supposed to be, which is issue of share at full market value. And we're going to be bringing that under the financing activities as we wrap it up. Note V. Warranty costs are included in cost of sales. Wait. Warranty is a provision in accordance with IAS 37. You remember that because an entity must make provision for warranty. Why? Because there is a present obligation. It could be constructive or it could be legal. So if you go back up into the statement of financial position, you can see here warranty provisions under the current liabilities. What are you seeing? The warranty provision is increasing. Now, increase in liability is what? An expenses. So it means the increase in warranty had been added to cost of sales, which means it reduced the profit. So what do? We come and add it back to the profit. Very important. So increase in warranty. provision. So how much we got? 3066 minus last year's figure, 2568. So what do we have? 3066, 2568. That's 498. We are adding it based on the principle. Increase in provision is an expenses. So it was added to the cost of sales. It reduced our profit. So we add it back to the profit. Principles. All right. Let's continue. Ooh, we are done reading. Okay. So you realize that in the context of this question, we are drawing inspiration from IAS 37 provisions. We are drawing some inspiration from IAS 38, intangible assets. We are drawing some inspiration certainly from our regular customer, IAS 16, property, plant, and equipment. And then also IAS 12, income tax. You're going to see it in the moment as we bring the discussion home. So we are done reading, and we are done with the adjustment that has to be made to our profit. So let's get profit from operations. Then we can bring in the movement, or if you want, changes in working capital. So changes in working capital, let's go back into the financial statement. Remember the rule. Increase in current asset means outflows. So when that happens, we subtract. Decrease in current asset means inflow, so we add. The reverse is true for the liabilities. Increase in liability means you are not paying people, so it's an inflow, positive. Reduction in liability means you are paying people, so it's an outflow, negative. That's the principle of the way we deal with movement in the working capital when it comes to the cash flow statement. So let's look at the inventories. What are we seeing? The inventories figure is going up. Then receivables also going up. It means outflow, meaning our debtors are not paying us quickly, so we're losing money. So we bring in increase in inventories, increase in receivables. So let's see, inventories will be 65,586. Minus, what do we have? 56,880. Receivables, 26,574. Minus 23,352. Okay. So that's the idea there. Let's see. We will come back to the cash and cash equivalent in a moment. Let's go to the liability side of things. Trade payables. What is happening to the trade payables? Trade payable figure is reducing. It means you are paying your suppliers. So reduction in trade payable is an inflow. Sorry, it's an outflow, not an inflow. So reduction in trade payables because we are paying them. And what do we have? 138,972 minus last year's figure, or current figure now, 85,794. There we go. Now, the tax, we will deal with it in a moment. The overdraft, we will talk about it in a moment. So don't worry. We've touched the lease already. We've touched the warranty already. So let's get these coming up arithmetically. So 65,586 minus 56,880, and that is Remember, it's an increase in inventory, so money is going out. 26,574 minus 23,352. And that is 322, also an outflow. $3,222, also an outflow. 138,972 minus 85,794, that is 53,178. Also an outflow because you are paying your suppliers there. So that is all. Let's get the arithmetics coming up from the top there. 7794, 4854, 300, 14370, 1956, 498, and that gives us 29,772. And so arithmetically, minus 8706 minus 3222 minus 53178, and that is 35,334 negative. It means the entity is not generating a lot of money from its operations. Now, this is where corporate reporting students' analysis of the cash flow will come in, right? So that will be cash flow from operations. But we're not done. We're left with two key things that must come here. Let's see if I can adjust my slide a little bit. We need interest paid. So since on the face of the statement of financial position, under current liability, we don't have any finance income or accrued interest, it means the interest expenses incurred during the year, recognized in the P&L, is the same interest that was paid during the year. So the finance cost that we added above, 4,854, that's what we're going to subtract here. Okay, then income tax paid. That we have to work for. So we can go to workings 3 in our workflow to finish it up. So workings 3, income tax. And we're going to bring in both the current and the non-current tax. In other words, you will bring the current tax and the deferred tax into a single account so that you can get the income tax expenses paid during the year. So you're going to bring in the balance brought forward. We'll have current tax. We'll have deferred tax. Same thing is going to happen on the closing side of things. So balance carry down like this. So let's see what is happening to the current tax. Now, you got to be careful because in some cases, the current tax, like the taxation that you are seeing under the current liabilities, may be under current assets, and that will be a tax refund. So you got to be careful, which will mean then that the income tax expense charge for the year, which you are seeing negative here, you would rather be seeing a positive figure, right? And that's the idea, meaning that during the year, the entity is having a significant tax refund that they have to receive from the government, from the tax authority in the form of deferred tax asset issues. So the current tax is 1,005 against 1,008. So 1,005 opening, 1,008 closing. Deferred tax, here we go, 648 opening. Closing is 1440, 1404. Okay? Then you go to the P&L and look at the tax charge for the year. what I mentioned a moment ago. So if you check, the tax charge for the year is negative. So the double entry for that is to debit P&L and credit the tax account. So it will come on the credit side of our tax account charge for the year. And that is 4032. Now, if that figure was positive, then that will be a deferred tax asset scenario. So it will be credit P&L, and then we would have debited the tax account. So be careful of your double entry application of the principles as you go. As I say always, you don't say charge for the year. So every time you're going to pick that figure and bring it to the credit side. No. If it is positive and you bring it to the credit side, au revoir mon ami for you, because you just got zero. So you got to be careful about that. Okay. So it appears we're done. Now, there is no other comprehensive income here. Remember, deferred tax implications can also be in the other comprehensive income. So really, what you are bringing into the tax account is both the tax in the P&L and the tax in the OCI. So when we say charge for the year, it is both the tax in the P&L and tax in the OCI. Again, be mindful of that, because the principle is the principle. But that's all in the context of this question. So let's balance the accounts. 1,005, 648, 40, 32. And that is 6180. It appears the credit side is bigger. So certainly the balancing side, or the balancing figure, will be on the debit side, which will be deemed as the tax paid during the year. Minus 1,800. 1404, that is 2976. So that is the figure we are looking for into the operating activities, 2976. Negative, because it is tax you are paying. So we are done. Now we can get net cash flow from operating activities. As I mentioned, dividend could be here. Okay, but I'm going to take the dividend into the financing activities. But dividend can be in the operating activity or in the financing activity. It doesn't change anything. Net cash flow from operating activities. So let's see, 35, 334, 48, 54, 2976, and that is 43, 164 negative. So from the corporate reporting class, if you are interpreting this, it tells you that the entity is not generating significant amount of profit to finance its operating activities, which is not a good thing. And we've done analysis of the cash flow. The principles are there. You've seen it already. If you have not, you're going to be seeing that under the evaluation of financial statement segment. And then under the practice questions videos also, you're going to be seeing that analysis of the cash flow and the principles I explained there. So let's come back into the investing activities. We got our proceeds from the disposal of the plant. Let's finish up with our PPE, because we are done with the PPE. Let's balance it up and see if the entity acquired additional assets during the year. 14,370 plus 5790 plus 96,624, and that is giving us 116. Okay, it looks like the credit side is small. 116,784. 116,784. So the balancing figure will be on the debit side, and that will be additional acquisition of assets, which will go under the investing activities. Okay, so purchase of PPE during the year minus 83,503, 508, and then 5760, and that is 27,516. So that is from workings 1. We will say acquisition of PPE. Now you write that in full, certainly, as always. 27,516. In the context of this question, that will be all for our investing activities. We were not having investment income, dividend received by the entity, government grants received by the entity. So that's all about this here. So we'll get the net cash flows. That's also negative from investing activities. But if your investing activities is negative from the analysis point of view, that's good because it tells us that the entity is buying assets, which we are seeing here. So there will be increase in future economic benefits. So 22 and 26 for us, net cash flow from investing activities. Then finally, cash flow from financing. So cash flow from financing activities. So as we mentioned, everything is cooked here for us, so we're just going to celebrate and go away. Usually, the examiner wouldn't have given us the statement of changes in equity. In that case, we would have been the one to calculate the dividend ourselves using the retained earnings, right? That's the principle. But here is there, so we're going to pick what is there like that. So dividend paid will come. And it's directly there, 3,000. That's an outflow. Next, we bring in the issue of shares. As we are told, it was issued at full market value. So the whole 900 is going to come. That's an inflow. Next, we're going to bring in what was the other thing? Issue of loan notes. If you remember, the 7% loan note has gone up in value. So certainly we will say that the entity has issued loan note. So the 7% loan note is going to be coming up from 9,000 to 41,700. So issue of 7% loan notes. That's an inflow for us. And so we bring that in. That's 41,700 minus 9,000. So 41,700 minus 9,000, and that is 32,700. Okay. Then the lease issue has to be brought. So finance lease payment from workings 2. Let's balance this account here. 270, 2136, 5760. It looks like the credit side is bigger. 8166, 8166. So that the balancing figure will be on the debit side as the lease paid during the year. Which is 900 plus 5758. And that is 1308 for us. So that's the figure we are looking for to bring here, 1308. There you go. So in the context of this question also, under the financing activities, these are the things there. We've brought the equity issues, we've brought the dividend, we've brought the loan issue, we've brought the finance lease obligation, That is all there. So we add it up. It looks like when it comes to the financing activities, we're going to have a positive indicator because the entity issued some shares but issued a lot of loan notes, which will increase the gearing level of the entity. If you are analyzing the cash flow, corporate reporting students. So I'm getting 29,292 positive. So that's net cash flows. So net cash flow from investing activities. Right? Investing activities. So now we are done. So we add the 3 up to give us net increase if it is positive, net decrease if it is negative. So let's go. So I have the 29 down, minus 22 and 26, minus 43,164, and we get negative 35,898. So since it is negative, we'll say net decrease in cash and cash equivalent. Net decrease in cash and cash equivalent. So that is 35,898. It's negative. So that is why we'll call it net decrease in cash and cash equivalent. Then we bring in the cash and cash equivalent brought forward, which is the opening figure. So cash and cash equivalent brought forward. And that will be last year's figure. Go back here. Under the current asset, last year figure, cash at bank and in hand, 45,108. It's positive, so you're going to add it so that you get a cash and cash equivalent at the end of the year. Brought down. So my answer plus 45,108, and that is 9210. Now, is that the cash and cash equivalent at the end of the year? Let's go confirm. At the end of the year, the entity is having, stay with me carefully here, they are having cash of 21,948. They have an overdraft of 12,738. So let's get the difference of that. 21,948 minus 12,738. That gives us 9,210, which is the cash and cash equivalent figure we got at the end of the year, positive 9,210. That is how you know your cash flow statement has balance, and this is the answer to the question. Very sweet, simple, straight to the point. So the cash flow from operating activities, again, application of the principles, because the cash flow is, diving you deeper than the single entity may have dived you, because you should have known how the thing was treated in the P&L account, then what you have to do to it in the cash flow statement, right? Investing activities, the proceeds from the sale, acquisition of the PPE, financing activities, and getting the balance. Then certainly the workings, PPE workflow, finance lease workflow, and certainly the third slide, which is the income tax calculation. So when it comes to the preparation of the cash flow statement, these are the things that we must understand and be mindful of. And that is the answer to that 17 marks question for the examination. And so 17 times 1.8, you're supposed to use 31 minutes for this approximately. 31. And that includes reading the question, going through these workings we've done, certainly extracting the financial statements and calculating, okay, doing the various calculations. So as I say always, speed and accuracy is going to be your best friend in the exam hall, because if you are slow, then you're going to be toasted. You're going to be toasted. Now, there is a theory question available there that the examiner asks students on, which is 3 marks on the benefits of the cash flow statement. There are a lot of benefits of the cash flow statement that you need to know about, because it tells us about, if you check what we have done here, it tells us about the sources of cash inflows during the year and the things that the entity paid or used the money for. So that is a key thing there. Number 2, the cash flow statement helps us to measure the survival level of a company, because a company that is cash strapped, doesn't have a lot of cash, will collapse. The fact that a company is profitable does not mean it can survive. So if we want to assess the survival of the company, it's not about profitability ratios. It's about the cash flow position of the entity. Because when expenses are piling up, debts are piling up, you need money to pay, not your profitability. So that is another benefit of the cash flow statement that we need to also be mindful of. And also it tells us about the future outcome of the entity, whether there will be future economic benefit flowing to the entity. As I mentioned, for instance, under the investing activities, we see the entity has acquired some PPEs. It means the entity is going to put those PPEs into use, and there will be increase in future economic benefit in the future. Although they sold some of the plants, they have replaced it with maybe an advanced plant, which means productivity, profitability is likely to increase going into the future. And these are the things you must understand when it comes to the cash flow statement preparation, single entity financial statement. So that's it about that. Any questions? I'm seeing some chats coming up. I don't know. I'm not able to pull. Let's see if I can bring this up. Okay, here. Fireman Faustin said, "Thank you so much, my best accounting lecturer. It's a pleasure, Fireman. Thanks for joining us on the stream today." All right. So, as I mentioned, you want questions like this solved, explained, principles crystallized, and many more. You can get access to our practice question course on our website, NhyiraPremium.com, and enroll in that course. Get access to questions like this solved, explained, and you'll be able to also join our Executive Leadership Masterclass by enrolling in that course. So enroll in that course because we have numerous videos covering all aspects of the syllabus to help you, put you in the position to prepare well for the examination, and most importantly, pass the examination. So you can head on to our website, NhyiraPremium.com, or download the Nhyira Premium mobile application on the Google Play Store or the Apple App Store, or send us a message on WhatsApp, and you will be assisted so you can complete your enrollment and study under my mentorship. Remember, passing the exam is easy if only you are willing to work hard. Don't wait a week to the exam, 3 days to the exam, and take leave. No. You're going to screw yourself up. Put yourself in the position so that you learn every day. At least every week, you must commit between 8 to 12 hours for each of the subjects you are writing. 8 to 12 hours every week. And you must be consistent, because that is how you can understand all of these things well and put you in the position to go into the exam hall and pass the examination. So that's it about that. And thanks for joining us on the stream today. God willing, on Friday, same time, we are going to be meeting to continue with our discussion. And really, really thanks for joining. Those of you with the likes, we see some of you sharing the videos as well. Thank you very much for the likes and sharing them. And I'll see you same time on Friday as we continue with our discussion. Stay safe and stay blessed.